Welcome to The Explainer. So, what if everything you think you know about getting rich is just plain wrong? Today, we're going to tear apart the myths and look at the actual data behind the contrarian and kind of boring path to real wealth. All right, let's get right into it. We're always bombarded with images of flashy cars and risky bets, right? Like, that's the only way to make it big. But you know what? The real data tells a much quieter story. So we're going to challenge those myths and look at how money actually works, starting with the two basic ways you can earn it. And really, your entire financial life boils down to this choice between these two different worlds. It's a choice between what you do for money and what you own that makes money for you. So on one hand, you've got active income, your salary, the money you get from your job. It's super important, obviously, but it's also kind of a trap. Why? Because there's a hard limit on how much you can make. There are only 24 hours in a day, after all. But then you have passive income. This stuff flows from assets. You're talking stocks, real estate, businesses, things that are out there working for you 24/7. And this right here is where the whole game changes. And here's where you see just how tilted the game is. The tax system, it just loves owners more than earners. It's wild. If you're a high-earning professional, you could be giving up to 37% of your paycheck to federal taxes. Just think about that. A huge slice of all your hard work is gone before you even see it. Now compare that to the money your assets make. Things like long-term capital gains or dividends. They're often taxed at a way, way lower rate, maybe 15 or 20%. The system is basically screaming at you. It's better to own stuff than to earn a paycheck. Okay, so if the whole point is to move from earning to owning, how do you know when you've actually made it? How do you know when you've crossed that financial finish line? Well, turns out there's a name for that moment, and even a formula. They call it the crossover point, and it's exactly what it sounds like. It's that magic moment when your passive income, the money your assets make, is more than your total living expenses. Your financial engine officially switches from being powered by your time to being powered by your money. And from that day forward, going to work, that becomes a choice, not a chore. And the cool thing is, you can actually figure this out for yourself with a super simple but really powerful formula. You just take your annual expenses, everything you spend in a year, and divide that by the return you expect to get on your investments. The number that spits out, that's it. That's your freedom number. That's the amount of assets you need to hit to be totally financially independent. So let's put some real numbers to this. Let's say you need about $60,000 a year to live your life, and you feel pretty good about getting an 8% return on your investments. Well, you do the math and boom, your target, your freedom number is $750,000. That's the goal. Okay, so now we have a target. But who are the people who actually hit these numbers? Because let me tell you, after decades of research, we know one thing for sure. The real millionaire next door looks nothing like the ones you see on Instagram or reality TV. This is the actual profile of a millionaire. And yeah, it's probably not what you were thinking. These people are masters of financial defense, not offense. They live way below their means. They care way more about financial independence than they do about showing off status. And get this, a whopping 80% are first-generation rich, often from owning what you might call dull businesses. So yeah, forget the Rolex, they're much more likely to be wearing a Seiko. And you know what's really wild? These core habits haven't changed a bit. The original research on this was done back in 1996, and they updated it 20 years later, and the findings were basically identical. It just goes to show you that discipline, living below your means, and thinking long-term, these aren't trends. They're pretty much the timeless laws of wealth. So it makes sense that this disciplined mindset carries right over into how they invest. And it really sets up this classic showdown, right? The slow and steady tortoise versus the fast, adrenaline junkie hare. Warren Buffett absolutely nailed it with this one. He said the stock market is a device for transferring money from the impatient to the patient. It's all about investing versus speculating. And the hard data on which one actually works, oh man, it's brutal. So let's talk about the hare for a second. The day trader. Check out this massive study of traders in Brazil. Of all the people who tried day trading for more than a year, an unbelievable 97% of them lost money. Just let that sink in. 97%. That's not a strategy, it's a financial cliff. And that wasn't just a fluke. Another huge study, this one over 15 years, looked at the entire Taiwanese stock market. The result? Fewer than 1% of day traders made any kind of reliable profit after you factor in fees. The odds are they're completely stacked against you. And it's not just happening somewhere else. Right here in the US, during that big retail trading boom recently, regular investors who were trying to time the market with options lost over $1 billion. A billion. The evidence is it's overwhelming. For almost everyone, day trading is basically a guaranteed way to set your money on fire. So, okay. The big takeaway here is pretty clear, right? If all the data shows that trying to outsmart the market is a total loser's game, what should you be focusing on? Well, the answer is surprisingly simple. Focus on the one and only thing you can actually control, and that's you. Okay, now this might be one of the most important and honestly surprising ideas in all of finance. Listen closely. Early in your journey, how much you save is way more powerful than how much your investments return. Just look at this. If you save 5% of your income, even if you get a crummy 1% return, you end up with more money after 30 years than if you only saved 1% but got an incredible 10% return. That's insane, right? The lesson is crystal clear. You have almost total control over your savings rate, but you have zero control over the market. And that's where your real power lies. So, how do you build that discipline to save? It all comes down to financial literacy. And according to studies from all over the world, you don't need to be a Wall Street genius. It really just boils down to understanding 3 simple core ideas: compound interest, inflation, and diversification. And the payoff for just knowing this stuff is huge. Seriously. Research shows that having a high level of financial literacy is like having a shield. It helps you fight off all those expensive emotional mistakes, like panic selling when the market dips or chasing after some hot stock. The more you understand, the less likely you are to let your own emotions wreck your plan. And that really leaves us with one last big question to think about. We spend so much time and energy trying to pick the perfect stocks or optimize our portfolios. But what if all the evidence is pointing to a different conclusion? What if your greatest financial asset isn't your portfolio at all, but your own psychology?